Hello, and welcome to our webinar on the coronavirus and how it will impact golden supply chains. I'm Andrew Thake, Global Head of Content, Production and Strategy for Minds and Money. Before we start, a couple of housekeeping comments. The webinar is scheduled to run for 45 minutes. All registrants will receive a copy of the recording of this webinar via email. You can ask questions at any time by using the questions tab in the GoToWebinar panel on your screen. And if you experience any trouble with sound, we recommend that you exit the webinar and then log back in again. Also, during the webinar, we will be referring to the document Gold, Strategic Review for Investors, which you can download on the panel to the right of your screen. Just to set the scene, for the last 10 years, we have seen unparalleled economic growth, with stock markets reaching record highs. In the gold industry, the price of gold has been rising since May 2019, hitting a 7-year high in February of this year. However, we all feared that a recession was something that was inevitable at some stage. Despite the best efforts of politicians, banks, and the finance industry, boom and bust cycles are inevitable. What nobody would have believed was that the next global financial crisis would be triggered by a virus, COVID-19. Coronavirus has led to increased volatility in the gold price, even though its supply chain is in theory shorter than other sectors. So what does coronavirus and the economic downturn mean for investors who traditionally view gold as a go-to investment in times of economic crisis? How may gold be able to help you in light of global concerns over COVID-19? Can we learn anything from previous economic downturns? It's certainly not great for conference organizers, speaking events with the safety of our customers foremost. We've put on hold organizing physical events until the second half of 2020. However, we still want to connect with our customers, providing them with timely information, hence this webinar. So, to help me answer these questions for today's webinar, we are joined by Simon Popple, who has been in the finance industry for 37 years. After an illustrious career at Singer & Freelander, ABN AMRO, Stratton Parker and Poplar, in 2008, Simon set up Brookville Capital, a capital raising business which subsequently won mandates with, amongst others, the Bank of China and the Fleming family and partners. Brookville provides Simon with his daily contact with institutions such as pension funds, sovereign wealth funds, private banks and family offices seeking to deploy capital in real assets such as agriculture and gold. He's previously written 2 newsletters, Metals and Miners for Money Week and Gold Speculator for Agora. He now writes the Brookville Capital Intelligence Report, which covers gold and silver mining stocks. Simon, welcome. As I said in my introduction, you've been in the finance industry for 37 years. Have you ever seen an economic downturn like this before?
No, I haven't. No, I mean, I think this is very much unprecedented, and I think that it's scary on a number of fronts. I think people have been scared previously. Watching investments go down is scary enough, but worrying about your own health and the health of family and friends is a real concern for everyone.
And is a recession inevitable?
It's difficult to see anything but a recession. I think that it makes sense to prepare as if we're going to have one, because I think there's a good chance that we will have one. And I think if you're prepared, then should it happen, you'll be in the right boat.
Mm-hmm. So how is gold currently performing?
Well, it's very volatile. I mean, it was up massively yesterday. I mean, at one stage it's up over $100, and it came back a bit. This morning it was down, I think, about $20, but it's very volatile. I was talking to friends who were trying to get physical gold, and they were really struggling with that. So yeah, I mean, I'd describe it as volatile, but I think it's broadly acting as a safe haven that we expect it to be.
Sure. And I think we're going to bring up a slide up on the screen now, which probably leads directly into my next question. Are there any parallels that we can draw with previous downturns?
Well, I mean, as you can see from the slide, I mean, when the S&P has fallen in other situations, you know, gold's actually performed pretty well, and you know, it has a good track record of being a safe haven asset, which is why I think that, you know, if you prepare for a downturn by having at least some gold in your portfolio, and I think a lot of people have got none, then I think, you know, it should serve you very well.
Sure. Okay. So I think that leads into the first interactive polling question of the webinar, which is coming up on the screen now. And again, just for those who've dialed in slightly late, I'd encourage all of you to go and vote on the question that's coming up on your screen. Or indeed, if you've got any questions which you'd like Simon to answer, please go and send them through, and we're able to go and get through to them during the course of the webinar. So just to bring the first question, first polling slide up on the screen is, where do you expect the price of gold to be in 12 months time? Below $1,400 per ounce, between $1,400 and $1,600 per ounce, between $1,600 to $1,800 per ounce, $1,800 to $2,000 per ounce, or above $2,000 per ounce. So we'll leave the poll open for about the next minute or so, enabling you all to vote. Whilst our audience are voting, Simon, what's your prediction?
Well, I think a lot depends on how long this crisis goes on for. The longer it goes on, the worse the economy is going to get hit. You know, we'll go into some of the reasons why later in the webinar. But you know, at the moment we're sort of probably around the 1600 mark, and it's difficult to see why it shouldn't go up to 1800, given, you know, here in the UK we've got a lockdown of it sounds like at least 3 weeks. But if it goes on for much longer than that, then it could well be, you know, significantly higher than that. But I think the bottom line is everything's pointing towards a higher gold price than a lower gold price.
Let's see whether the audience agree with what you had to say, Simon, and we'll just bring the answers up on the screen. So no one, unsurprisingly, thought that the price would be below $1,400 an ounce. 20% was between $1,400 and $1,600 per ounce. 30% between $1,600 and $1,800 an ounce. 37% between $1,800 and $2,000 per ounce, and 13% of you thought would actually be above the $2,000 per ounce mark. To the next question, this is really kind of like a core part of the webinar, and I also it's an area that you've been looking at in some depth. It's about gold supply chain, and again, I think we've got another slide coming up on our screen now. Simon, why has COVID-19 led to increased volatility in the gold price, even though its supply chain is in theory shorter than other sectors?
I think it's largely down to uncertainty. You know, people have never faced this sort of crisis before, and, you know, understandably, you know, they don't know what to do. And I think, you know, what you found is, you know, a lot of people buying physical gold, and you know, there's talk of there being a disconnect between the physical and the paper gold, because you know, people previously have been very happy trading paper gold, because we haven't been in a crisis like this before, but now we're in a crisis like this. People are perhaps saying, well, actually, you know, I want physical, I'm not interested in paper. So I think that's probably one reason for the volatility. But you know, we're only just really in the first few days of the lockdown, so I think it's going to take a while for this to play out. And obviously, you know, let's see what happens in the US, which is, you know, clearly a huge market.
Sure. I think specifically on, like, why is the simplicity of gold supply chain so important in an economic crisis?
Right. Well, dividends are incredibly important to a lot of investors, you know, particularly retirees who need an income. And I think that one of the kind of rookie mistakes that people are making at the moment is by assuming that the future will follow the same path as the past. And so what they're doing is that, you know, they're looking at a share price which has obviously come down a lot, and they're comparing the previous dividend to the share price, which is actually chucking up quite a nice yield. But because a lot of companies have got fairly long supply chains, I think they're going to really struggle to match historic performance. And in terms of matching that performance, I think that some will actually struggle to pay at least the same dividend, and others may not be able to pay any dividend at all. So I think people need to be very careful about where they stick their money. If they're sticking it into equities with a view to getting a dividend, they really need to have a long, hard think about, is this company going to be able to maintain its dividend?
Sure. Sure.
So
and then,
just moving on from that, I think that looking at this slide, you'll see that the value in gold mining companies is created earlier in the process. So I'm not saying you should have all your money in gold companies, but what I'm saying is, if you've got none or very little, you need to have a good look at them.
Yeah, and I think just kind of like delving a little bit sort of deeper, how have reported dividends changed over the last few weeks since COVID-19 hit?
Well, if you think about when most companies have their year end, it's either 31st of December, 31st of March, 30th of June, or 30th of September. So now we're coming towards the end of March. A lot of companies are going to have to start reporting their quarterly numbers in the next few weeks, the first couple of weeks in April. And I think that's when there's going to be some real issues in the market, because to date, people have really been reporting sort of normalized figures, but we've only had 1 month really, I think, of the virus really impacting globally, which is obviously March. So when that goes into the next quarter, I mean, they're already talking about suspending reporting of information, which is pretty bad. But it's not only the reporting of the information which I'm concerned about. It's actually the information itself, because not telling people is one thing, but if your performance has been massively impacted by the virus, then people are going to be even more uncertain than they are at the moment.
So let's sort of like work out as to how we can turn that into sort of like practical advice. Simon, obviously you've got a number of high net worth individuals that you advise. What do you recommend to them about why they should have gold in their portfolio? I understand you have a fancy football system.
Yeah, no, absolutely. I mean, everyone's different, and every mining company is different. And this is a new area for a lot of people. So what I'm trying to do is sort of break things down into a language that people can kind of readily understand. So just really cantering through it pretty quickly. You've got the stadium and the pitch, which I call my physical metals. You've then got goalkeepers, which are the very large, tend to be sort of 5 billion plus market value companies. And then your defenders, which are sort of 1 to 5 billion market value. Your midfielders are probably 100 million up to 5 billion. And then you've got your forwards, which are kind of your out and out sort of explorers. And so what I'm trying to do is enable people to look at the market in a way that sort of suits them. So if you're already retired, you probably want to be thinking about stadiums and goalkeepers. If you're approaching retirement, perhaps you could have a few defenders. If you're a bit younger, then have some midfielders. And if you're very young and you like a bit of speculation, then you can go for some forwards as well. But these are very speculative. One was up 137% overnight, and they bounce around a lot, the forwards. So if people want to move into the market, that's fine. But I suggest they have a sort of balanced portfolio.
Yeah. And then there's a question being sent, which has been actually sent in. In terms of a balanced portfolio, what proportion of your assets should you have invested in gold?
I think that's. I don't think it's ridiculous to have at least 1%, and I mean most people have none. And there's a lot of people out there that say you should have around 10%. So I think that pick a number between 1 and 10, and I'd say a lot depends on how you want to invest in gold, whether you want to just invest in physical or the mining stocks where you've got the leverage to the gold price, and also the kind of mining stocks you want to invest in. So a lot depends on your age, and but I certainly, the thing I like about gold is it's universally recognized across the world. So if you take a gold bar, you'll attract the same interest in India, Russia, Colombia, wherever you take it. Whereas if you take your fiat sterling, ruble, Aussie dollar, whatever it is, clearly that's far more attractive in the markets where you can actually spend it.
Yeah. In terms of, do you have any sort of like factors which one to consider when investing in gold? Do you have any specific like guidelines that you can give to clients?
Yeah, well, I think first of all, you need to be very clear as to what you want to achieve, and are you looking to protect your wealth? Are you looking to make money? What is your what outcome do you want? And if you're looking to protect wealth, then clearly it makes more sense to look at the physical metal and perhaps the goalkeepers. But if you're looking to make money, then midfielders and forwards, on the one hand, they're more speculative, but on the other hand, I think there's a slide later on, but people in the bull market in the 1970s were making 10, 50, 100 times their money. So it really depends on your sort of appetite for risk and what you want to achieve.
Sure. I think we're now going to have a slide that's going to be put on the screen, which shows the relative value of gold versus other currencies over a period of time. So perhaps that can lead on to the next question: how has gold performed as an investment over time versus currencies?
Well, as you can see from this graph from the World Gold Council, I mean, gold, when it came off the gold standard, or currencies came off the gold standard, as you can see, they started heading south at some rate, and I think this is one of the key attractions about gold is it has been a good protector of value, and with a lot of people thinking about their retirement, it's a bit of a double whammy really, because on the one hand you've got your currency, and someone yesterday was asking, what currencies should I be in, and I said, well, given your house and your earnings and a lot of your wealth is in sterling, it makes sense to have at least some of your wealth in other currencies and or gold. And so I think people do need to think about gold, and the main argument against gold over the years is it doesn't yield anything, and I think that was to be honest, a pretty valid argument. But now you've got negative interest rates in many areas. I don't think that really holds true, and therefore the main argument for not holding gold has sort of gone out the window.
Yeah. Another question that's just been sent through: in terms of holding currencies, do you have any recommendations as to what percentage of your portfolio should be in US dollars?
Not really, no. I mean, I just think what I would say is that you probably want to hold the currencies that you envisage spending over the next few years. So if you're planning to go to the US on a nice holiday or go on a cruise, I think a lot of cruise ships only accept dollars. But you don't want to complicate your life any more than it's complicated at the moment by having to sort of worry about currencies. So which is one of the reasons why I like gold, because gold is sort of fairly agnostic as far as currencies are concerned. So if people hold a proportion of their wealth in gold and then a proportion of their wealth in currencies which they envisage using in the next year or two, then they should be able to at least enjoy their life.
Okay. This kind of leads onto our second question. So onto our second polling question, which is coming up on the screen now. which is if you had US $1 million to invest in gold, what would you invest it in? And we've kind of narrowed it down to sort of like 5 sort of choices. So what's the best way of investing US $1 million into gold? Gold producers, exploration companies, royalty and streaming companies, ETFs, exchange traded funds, or gold bullion. Again, whilst we're inviting our audience to vote over the course of the next couple of minutes, Simon, what would you advise your clients if they had US $1 million?
Well, I'm obviously very keen on the mining companies, and the only one that I'd be concerned about on that list are the ETFs because of counterparty risk. So you know, it's very much a personal sort of position, but I like to have a bit of physical. I like the gold producers because they've got leverage to the gold price, and if you pick the right exploration companies, if they find gold, you know, the share prices can go, you know, through the roof. Likewise, royalty and streaming companies, you know, especially some of the larger ones, which are essentially funded by debt, which has been pretty cheap, and then using that capital to deploy in mining companies, you know, particularly junior miners, where they can get, you know, fantastic returns, and that's why a lot of them, you know, trade on very attractive multiples. But I'd say the only one I'd be a little wary of personally are ETFs, because you know, I don't really like counterparty risk, and they do tend to have perhaps more counterparty risk.
Can you just explain briefly the sort of like what is the kind of like your concerns around counterparty risk?
Well, yeah, I mean, I think there's various things. I mean, first of all, there's more links in the chain. You've got trustees, you've got custodians, and there's, you know, you could have, you know, Lehman's is just one example, but I mean, if one of those links falls over, then yes, they could be replaced, but you know, I'm not sure, without sort of having a lawyer go through the detailed documents, what my position would be as an ETF holder if something went wrong. And I think the other thing is, you know, they talk about you can have physical delivery, but in all the instances I'm aware of, you would actually have to own a huge amount of gold to actually be in a position to take physical delivery. And if the ETF decided that they didn't want to deliver physical gold to you, they could tell you, you know, they're perfectly within their rights to tell you you can't have it. So I think the, you know, I'm not expecting any Armageddon or anything like that, but I think that, you know, what I like is by having some gold bullion, then that's my kind of my lowest risk position, and then by having gold producers, explorers, and royalties, you know, I've got an opportunity to make some money.
Okay. So I think we can now close the poll and bring the polling results up on the screen. So 31% of you went for gold producers, 16% exploration companies, 23% royalty and streaming companies, 22% exchange traded funds, and 9% voted for gold bullion. Let's move on to the next question. Simon, when you and I were chatting last week, you were saying that gold could become to millennials what real estate was to the likes of you and me. What do you exactly mean by this?
Well, if we do enter another bull market, and I think we've got a slide that shows the 1970s bull market compared to, you know, where we are at the moment, then you know, gold really could take off, or gold stocks really could take off, very much in the way that that, you know, real estate has taken off. And I think that you know, a lot of people view real estate as a one-way bet. You know, anyone who's only been investing in the market for the last 20 years has probably just seen real estate go up. You know, they don't remember the 1980s when I think it's the crash in '87, when you know, when things go bad in real estate, they go really bad. Now, I think that gold could be entering a particularly attractive bullish market. And so it would be no surprise to me at all if some of these companies did phenomenally well. And I think if you invest in the right companies, you could do very well, and make a lot of money like people have done in the property market.
Sure. Which kind of gold mining equities do you expect to perform best over the next year?
I think that the producers will do well, because I think if the gold price goes up, then it's a sort of double whammy for them. One, their margin expands. They should be making more money. You would normally expect the cost of the price of gold to outstrip any increase in costs. And the other attraction for gold companies is, if the price of gold goes up, then there's a good chance that their reserves and resources, or more reserves and resources, will become economic to mine, and therefore their reserves and resources go up, and obviously the market pays a lot of attention to what the potential is for these gold companies.
Yeah. Just kind of like connected to that is, what do you think is obviously what had been seen in the sort of like preceding 18 months was a lot of like mergers and acquisitions within the gold sector, with obviously sort of Randgold and Barrick, and then Newmont and Goldcorp, etc. What do you think is the potential for further M&A activity?
Well, a lot of people are talking about peak gold, as in, we're not going to be able to find much more gold. And I think that is driving a lot of M&A activity, because companies would rather buy a junior company with a proven resource and potential for a lot more gold than go and speculate themselves with exploration costs. And in the last downturn, gold companies that were viewed as perhaps wasting shareholder money on exploration that wasn't providing any meaningful results, probably learned their lesson, and they would rather pay a premium, especially at these kind of prices, which are still relatively low compared to perhaps where some of these companies have been in the past. So if they can pick up a company which is relatively cheap with a proven resource, then I think that's going to happen, which logically should lead to quite a lot of M&A in the system.
So let's have a third and final holding question coming up on the screen, which is, what's the main reason currently to hold gold? And again, we've had to narrow it down to 5 choices, but the choices that should be coming up on your screen now are COVID-19, portfolio diversification, weakness of the US dollar as a hedge against inflation, or supply constraints stroke peak gold. So again, we'll give everyone sort of a couple of minutes to sort of get their votes in. Whilst people are voting, Simon, what's your answer?
I think it's really all of the below, to be honest. I mean, COVID-19 obviously has created a huge amount of uncertainty, and no one knows how it's going to unfold at the moment. So I think gold is an asset class that makes sense to have some in today's circumstances. Portfolio diversification, a lot of people have got little or no gold, and for the reasons we perhaps discussed already, it makes sense to have some. The weakness of the US dollar, I mean, the US dollar is sort of moving around a lot. Some days it's stronger, some days it's weaker, but I think it's a useful alternative to have for the US dollar. The price of gold is certainly going up in US dollars, which is I think a good thing. Hedge against inflation, I think that makes sense. I think also I'd add to that the World Gold Council have said that gold is a good asset to have in deflation as well. So I think it's if you're worried about inflation or deflation, then having some gold is probably no bad thing. And then there's supply constraints, peak gold. Again, it's difficult to second guess technology, but I think that again, there's an argument for having some gold in your portfolio in case we are at peak gold, and it becomes more and more difficult to extract it.
Yeah. And this question has been sent in whilst we're probably having the polling. And the question is if COVID-19 caused the economic crisis, or would the economic crisis have happened anyway?
That's a very good question. Personally, I think the crisis was going to happen anyway, but I think COVID-19 has been a catalyst for the crisis, and I think that's another sort of very important point to think of, because I think when COVID-19 goes away, and I think we're all hoping that it does go away. I think a lot of people think that we're going to jump back into the world as it was, and I think that's far from certain. So with huge piles of debt out there, I think that's the main issue. I mean, you've got things like trade wars and Brexit, which are, I think, other elements. But yes, in answer to the question, I think that we were going to hit the buffers at some point, but COVID-19 has sort of probably brought that day forward.
Sure. And when you say that we were going to hit the buffers at some point, so I know when I was talking to some people yesterday, some were saying, well, we still haven't sort of resolved some of the sort of like the monetary problems that stemmed from the global financial crisis back in 2007, 2008. Why do you think that the economic crisis was inevitable at some point? It just happened to be that COVID-19 was the sort of like trigger.
Well, I mean, you mentioned 2008. I mean, I think what sort of unnerves me more about this crisis than 2008 was 2008 we had QE, and the expectation was that money was going to get paid back. And now we've got more money printing, huge numbers. I think it was 2 trillion or something like that by the US. And I think that QE worked last time because there's the assumption that the money was going to get paid back. Because it hasn't got paid back, I'm more concerned about how money printing is going to impact this time around. I heard a quote the other day which made me laugh, which was that cutting rates was about as useful as painting a sinking ship. Now I hope that's wrong, but I think until we see the benefits of this money printing and we come out the other side, I'm more concerned now than I probably was 12 years ago.
Okay. So with that in mind, let's get the polling answers up on the screen, see as to how you all sort of like voted. I think it's 21% COVID-19 as the main reason to hold gold, 46%, unsurprisingly, portfolio diversification, and the rest of you were evenly split between weakness of the US dollar as a hedge against inflation and supply constraints and peak gold. So we've now got just under sort of 10 minutes left, so I'll probably just ask a few just remaining sort of like random sort of like questions and throw in a few more questions from the audience. First question, Simon, what are the potential risks or downsides of investing in gold?
Well, again, it depends on what time frame you're talking about here. But I think that for me, I don't think there's a huge downside if you're sensible about how you invest. And what I mean by that is, I think you need to look at your, what I said earlier about, what outcome do you want? Why are you investing in gold? Are you looking to protect money or make money? If you're looking to protect and just investing in the physical, then obviously the price can move up or down, but that can happen with any investment. What I like about gold is it's tangible, it's real, and it can't be printed. So I think that for people looking to protect money, that should give them some comfort. If you want to be more speculative, then investing in the mining stocks, which is what my report is all about. Yeah, clearly there's a risk associated with that, but what I like is the fact that this gold's been around for millions of years, and the main difference is that these companies are founded and they're extracting it, and given that you can convert gold to money anywhere in the world, in a way these people, on the one hand they're mining gold, but on the other hand they're mining money, and I think that some currencies could really struggle in this downturn. So I think that just having an allocation of your money or your capital in gold sort of outweighs the potential downside, providing you've got it in a form of gold that suits your kind of appetite for risk.
Yeah. And how do you generate investment ideas, and which markets do you primarily focus on?
I really focus on Canada and Australia because I think you need to know your markets well, and I've got people in those markets talking to me on a regular basis. So I get good intelligence as to to what's going on, which is very helpful. Which is really more to do with the explorers and sort of forwards. But there's other markets as well. I mean, I obviously have to cover South America for silver. Mexico is the world's largest silver producer. So we keep a keen eye on what's going on there. But you tend to find a lot of companies operating in Mexico are actually listed in Canada or Australia anyway.
Yeah. And just historically, what's the best gold investment call that you've made in your career?
We've made a few. I mean, Metals and Miners, we invested in Saracen and Northern Star when they were only cents, and they're now, I think Northern Star is probably 50 times what it was, and Saracen is probably more like 20 or 30. I also flagged a company called St. Barbara when that was around 12 cents, and had a nice email from one of my current subscribers saying that they bought in and they sold out at $3.50, so they made a very nice return. So we've had a few situations where people have made 30, 40, 50 times their money, but it's not all about sort of that. I think it's important for people to protect their money as well, which is why I think it's nice to have a diversified portfolio with a bit of not a bit of everything, but a bit of whatever suits you. So if you want to make money, then there's a good chance that you can.
Sure. And are there any resources, either online or otherwise, that you would recommend for further reading?
Well, obviously, apart from my newsletter, the World Gold Council is a good resource. I'm doing some work with a guy called Rob Stewart, who has got a platform for assets, converting them into cash, which I think is very useful. But people just need to do some research and don't blindly go into gold companies, because they are all very different. So you do need to know what you're doing.
Yeah, I think it's the acronym DYOR, do your own research. I was taught that at a very young age, that's always the best advice that anyone's ever given me about sort of investing into gold or investing into anything. I think that's sort of like kind of I think we're kind of like run almost out of time, Simon. So I'd just like to give a big thanks to Simon, and also thank you to all of our listeners for dialing in. We'll be having our next webinar. We'll be running in a couple of weeks' time, which details will be sent out to all of you. Obviously, times are quite hard for all of us, but I'm a firm believer that the public situation will be under control by the middle of this year. I also do kind of agree with a lot of Simon's sentiments that we are going to see gold sort of like rise, and we're going to be able to sort of like see like a rising gold price over the next sort of 3 to 18 sort of like months. So I hope that you can all kind of capitalize on some of the opportunities that we've explored in this webinar. And also, finally, last but no means least, for more great news and content, please check out our Mining Beacon website at www.miningbeacon.com. And please stay safe, and many thanks, and see you again soon.
Cheers, thank you.